Hi students, today we're going to look at a very nice question from the 2017 past paper questions. That's paper 2 for POA, which is a CSEC examination, and we're going to look at the January edition. We're looking specifically at question number 2 on that paper. It's a very nice question dealing with inventory valuation. So let's dip straight into it. All right, so we're looking at Malal and Jack. The first thing that I encourage students to do when tackling your CSEC POA papers is to look at the requirement first. So we go straight down to A, and A is asking us, it says, Jack prefers the Fifo method of inventory valuation. Explain to Malal in one sentence how Fifo differs from the Fifo method. Already we know that this is a theoretical question, and it requires a simple answer because there is only one mark attached to that, only one mark to be gained. So let's read the scenario. It says that both persons operate a business trading in bicycle tires. They disagree on the inventory valuation that should be used. Malal only knows the Fifo method, and he insists that Fifo should be used to determine the value of the ending inventory for the 3 months ended 31st March 2016. All right, fair enough. If that's all he knows, then that is what he's insisting on. So Jack has the responsibility of convincing him to use the Fifo method. But Malal will want an explanation. That's what it is saying as to what the difference. Now, there are two assumptions that are made here. In the Fifo method is a method of inventory valuation that assumes that the stock that is sold first is the stock that was received last. And that's why it's called Fifo, last in, first out. So this assumes that stock received last is the stock sold first. And Fifo assumes, so we can just write that one time, Fifo assumes first stock received is last. That should be is sold. All right, simple answer, nothing elaborate here. On to the second part of the question. Once again, the rule is to look at the requirement. B says, complete the inventory form provided on pages 9 and 10 using Fifo method, and in the space below, state the value of inventory as at 31st March 2000 and that should be 2016. 31st March 2016. So we are doing Fifo, and this was the sheet that was provided on page 9. I do not think that we need both sheets for pages 9 and 10, but the method that we're using here is Fifo, which is the first in, first out method. First in, first out method. Oops. All right, so here we go. So let us look at the information provided. It says the following information is presented to you by Malal and Jack. We have for the months of January, February, and March, the first quarter. Beginning inventory, we have the units, we have the costs for January 1st. Then there was a purchase on January 17th. We have the units, we have the costs. Then there was a sale on January 29th. We have the quantity, and we have the selling price. Now, bear in mind that this $40 on the 29th is the selling price. That's not the cost of those goods that were sold. And then on the 12th of February, there was a purchase, quantity, cost. March 1st, there was a sale, quantity, selling price. Once again, this is selling price. 10th of March, purchase, quantity, cost. And lastly, 31st of March, there was a sale, quantity, and the selling price. So this is very important. What we're going to do, we're going to do the FIFO method. And for those who are more advanced, you will see that this is actually the perpetual inventory system that is used. We have an elaborate record keeping system here. So let's begin. The first thing that we do, remember the assumption is first in, first out. So whenever there is a sale, we reach for the stock that came in first. And that's how we do it. So let's go through this. We're in 2016. And January 1st is our first balance. This is not a purchase, so nothing goes here. The second sets of columns are sales. This is not a sale, so nothing goes on the sales. But this is a balance. It is our opening balance, beginning inventory. So let's put the quantities here, 100. And the cost price for this is $20. The total value would be 100 units multiplied by 20. And that will give us our total value in this column, which is 2,000. We do not have to put the dollar sign next to 2,000 because it's indicated at the top of the column. All right, so that was January 1st. Next transaction, 17th of January, there was a purchase, 2,000. That should be 200 units at $22 per unit. So we go down here to the 17th. There was a purchase, so we put the quantity under purchase, which is 200. The cost price is $22. And we do our multiplication. Do not go in the exam without a calculator. You will have to use it a lot here. And that gives us 4,400. 4,400. So what is our new balance? Our new balance will be from the 1st of January. We have to bring down that balance. And we are adding to that balance the purchase that we made on the 17th. So this is how we outline that. 100, 2,000 dollars, and we also incorporate this 200 at 22, which gives you 44. Okay. All right, so we get down to the next transaction, which is on the 29th. That's a sale of 240. 240 is the quantity here. That's what we're concerned about. We're not concerned about the selling price at this point. Now, 240, do we have 240 in stock? Yes, we do. We have more than 240. At this point in time, we have 100 and 200, which gives us a total of 300 units. So we have 300 units, but they are all valued at different costs. 100 is valued at 20, and 200, this 200 is valued at 22. Oops. 22. All right, $22 per unit. So how do we determine which batch these quantities of 240 units will come from? Well, that is simple. Remember that we're doing FIFO, which means we assume that when there's a sale, we are pulling from the first stock that came in. What is the first stock that came in? First stock that came in is from the first, which is 100. So that's where we begin to pull our stock from. So our sale, let's begin to put this down. Our sale, in this case, will be from that batch, but we still need another 140 because that only gives us 100. But let's record that 100 units first. 100 at 20. And the total value of that would be 2,000. Excellent. We still need another 140. There's only one batch remaining, which is the second set that came in. So we take that 140 from this batch at 22. When we take that, The total value of that is 3,080. When we take that 140 from this 200 units over here, we have how many remaining? We have 60 remaining. So we're going to fit that in as our balance here. We have 60 at 22 remaining. All right. And so our total value for that 60, when you calculate it, you should get 1320. Okay. So don't just take the 240 and choose the first quantity, which is 100 units at 20, and just put 240 on the sales at 20. That is unrealistic. It doesn't reflect the FIFO method. You have to, there's only 100 units that came in the first batch that is taken up, and you still need 140. So as you consume units or as you sell units, the first sets that come in, you will be moving downwards, and we'll have a new first set. This 200 units become our new first set. When we take from that, what remains is 60. So let's go to the next one quickly. There's a purchase on the 12th of February. So we're into a new month. Let's go February 12th. The amount there is 400. 400 at 25. And the total value of that is 10,000. Excellent. So what is our new balance? Our new balance will be from, all right, so we're bringing down our 60 at 22, 1320, and we are adding to that what we just purchased, 400 at 25, which gives us 10,000. All right. So this is pretty straightforward. Now we have a sale on March the 1st. So let's locate that. March the 1st. Not a purchase, it's a sale. What's the quantity? The quantity is 260. Can we get that from the first set that came in? No. We can only get 60. This is our new first set. All right, our new first batch. So we can only get 60 from that. Here it is. 60. So we'll take that 60 because we're doing FIFO, and we're going to put it in. All right, we're going to record it. So 60 at 22, which gives us 1320. But we still need more. We still need 200 more, 200 units more. And so that will come from the batch that remains. 200 at 25. And 200 at 25 gives us 5,000. All right. How are we doing so far? Good. So then what we have remaining when we take 200 from this 400, what we have remaining is 200. So let's put that as our balance. This stock at 22 is totally gone. We only have one set of stock remaining, which is at 25. And the quantity we have remaining is 200 because we just sold 200 from it. And that will be $5,000. Okay. So that's March. On March the 10th, what do we have? A purchase. This is straightforward, 130 at 26. And that gives us $33. That should be $3,380. Excellent. So what are our new balances? We have our 200 from before. We keep them in this order so that we can have them in the order of first in, first out. So the first in here is this 200. And we add to that our new batch from the 10th. And that is 3380. Excellent. Now let's go to our final date here, which is the 31st of March. And this is a sale, 250. Can we get that from the first batch that we have, or the earliest batch? In this case, we're looking at this figure here. 200, no, we can't get the full 250. So we take 200, we empty that batch. 200 at 25, and 200 at 25 is 5,000. So now this batch no longer exists. It is gone. This batch is gone. But we still need another, how many? 50. We still need another 50, so we take that from the next available batch. And this is at 26, and that gives us 1,300. So how much do we have remaining? We have 80. 130 minus 50 is 80. So that will be 80 at 26, and that gives us 2,080. So the answer to the question, what is the closing stock? It says complete the inventory form provided on pages 9 and 10 using Fifo method, and in the space below, state the value of ending inventory. So we go back over here. This was 11 marks. We've completed the table. And so we can see the value of ending inventory. All right, the value of ending inventory at 31st March 2016 is $2,080. Okay, so we're looking at part C of that same question, and this is what it requires of us. Using the information from the inventory form, that should be prepare the trading account for Mill Allen Jack for the 3 months ended 31st March 2016. All right, so we're going to use this same inventory form, and we're going to prepare the trading account. Now, if you look back at the question from before, there are some, or the information from part B, there are pieces of information or data that we're going to pull into this question to answer it as well. Okay, so let's begin. So we're looking at a trading account. Let's head it up. Malal and Jack. Trading account. It says for the 3 months ended 31st. We can say that as well. For the 3 months ending 31st March 2016. Let's put some dollar signs there. The first figure that we have to look at is sales. What is our sales figure? Now, this will require some calculations. You remember that when we looked at the question gave you not only sales quantities, but also the selling price. Selling price was not relevant to the inventory valuation form, but it is relevant at this point in time because it helps us to calculate our sales value. So let us, when we look back at the question, you will pick up 240. Let me just show you the calculation here quickly. Sales figure will be made up of 240 multiplied by a selling price of $40. Also 260 multiplied by a selling price of $42. And we also had 250 that was sold for $45. All right, so 42, 45. The total you get from this would be $31,770. For those who are wondering where these figures came from, you just look back at the information provided in that table in part B of the question. Look at the sales, the quantities, and the selling price, selling prices which are next to the quantity and you do the multiplication. So sales, we have our sales figure. We're going to subtract from our sales figure cost of goods sold. And cost of goods sold is made up of opening stock. We'll use inventory because that's the language here. Opening inventory. What is opening inventory? Here it is, across here. This is our opening inventory on January 1st. All right, so this is it here. The value is $2,000. So we pick that up. $2,000. And then we have purchases. What is the value of our purchases? We do a similar calculation, but in this case, we have the values here. Oops. Here they are, total values. We look in the total value column under purchases, and we add these figures together. So if we add these figures together, we'll end up with a total of 17,780. That's 4,400 plus 10,000 plus 3,380. So the total we get from that is 17,780. Not bad. The information is calculated for us already. We just have to do one tiny little bit of calculation more, which is to add our total purchases in the total value column. So that's purchases. And then we subtract. We add these two together. We get our cost of goods available for sale, which will be 19,780. And then we subtract our ending inventory. And that is our answer from the last part of the question, which is 2,080. When we subtract that, we get our cost of goods sold, which is 17,700. And we subtract that to get our gross profit. Gross profit is 14,070. Not bad. Easy 7-mark question there. Okay, so let's look at part D of the question, which says, describe in one sentence the effect on cost of goods sold and gross profit if Milal and Jack had used the Fifo method, which gives a lower valuation of closing stock. Well, if it gives a lower valuation of closing stock, you have a hint there, right? It gives a lower valuation of closing stock, which will mean a higher cost of goods sold, which will also mean a lower gross profit. Okay, so that's straightforward. So LIFO will result in a higher, so we can just write that LIFO results in a higher cost of goods sold and a lower gross profit. And that was for 1 mark, 1 sentence, 1 mark. So there we go. All 20 marks have been achieved. Congratulations. And I hope this was helpful to you. All right, so see you in our next question.